So hello, everyone, and thank you for coming to Investment Concerns in a Fragile Market. Before we begin, just one quick reminder, please keep all your questions until the end of the presentation. You can ask your questions in either the Q&A or the chat box. I'll be monitoring both places, and at the very end of the presentation, I'll read them out loud. Our speaker tonight is Mark Lange. Mark started his career in college as an intern developing computer models in the commodities markets. He very quickly learned that this was not the area of his calling, as it did not offer the reward that helping others gave him. This desire to collaborate with individuals led him to join American Express Financial Advisors. During his time at American Express, Mark completed the College of Financial Planning's CFP Professional Education Program and became a training and district manager. Mark's appetite to offer a complete non-proprietary menu of investment choices soon moved him from the American Express Financial Advisors to LPL Financial, the largest independent broker-dealer in the country. He is a past member of Putnam Investments Gold Scale Council and Goldman Sachs Blue Chip Council, as well as a former host of From Wall Street to Main Street on radio station WTBQ. So without further ado, I'm going to turn things over to Mark.
Thanks so much. It's always nice to get a nice introduction like that. After over 40 years in this industry, sometimes I look at it and I go, boy, it's interesting how little things have changed. Tonight, we're going to talk about investment concerns in a fragile market. So thank you to North Bergen for inviting me in. Whenever I do SOFA presentations, I like to let people know if you have questions about your personal situation as part of our commitment to SOFA, which is SOFA is a nonprofit organization started in 1993. We decided to join SOFA about 5 years ago, and we did so because we wanted to find a way to give back to our community outside of just doing the charitable components that we provide. And we really felt that literacy was one of the things that people in this country needed to learn about with regards to finances, because we get so many of the same questions on a regular basis. But as a result of joining SOFA, we always want to let people know this is strictly an education-only proposition. Sometimes I'll talk about different investment vehicles within the confines of our discussions, but I'm not advocating for one versus another. And if you have personal questions, please reach out to me via email. Gracefully, our host has asked you to save your questions till the end. If you're like me, I'm post 60 years old, please write them down on a pad because I don't always remember the things that I wanted to ask if I don't. So without further ado, let's get started. As I said, SOFA is nonprofit. We're not here to sell anything. I'm glad that you're joining me. Typically, I would have, if we were doing these things live, an evaluation form. You could fill it out and give me some feedback. We haven't been doing those while we do Zoom, so we're going to hop right into tonight's presentation. So let's talk about some of the common repetitive investment scenarios for people. So when the markets are down, typically your share prices are going to drop. Your number of shares are still going to remain the same. However, there's some things that I'm going to talk about with regards to that when we get to the end of this presentation, because I think they're fairly significant. But one of the key elements that I tell people when we talk about taxable losses or taxable gains, they all come as a result of an act, either on your behalf or for those of you who own open-ended mutual funds, on behalf of the fund in some instances. So it's very important to understand that you haven't actually recognized any gains or losses unless you act or they act. Very important to remember that. In many instances, for those of you that have long-term track records or long-term timeframes that you want to plug into, you want to be buying into these markets. So for those individuals, for example, who are 30 and less and looking at their retirement plans and saying, my God, I'm not sure what I should be doing, I will tell you this. If you look at the history of the market, considering all the different things that have transpired over that period of time, virtually every time that we see significant downturns in the market, it is a time to be buying. When is it not a time to be buying? Well, that depends on whether or not you're in accumulation mode. If you're in distribution mode, like many retirees today, that's not the key element for you. But we'll talk a bit more about that as we get further along. And the other question is, when you're reallocating dollars, be sure of the types of accounts and the taxing implications that are pertinent to those particular accounts. So if we're talking about retirement accounts like 401ks, 403bs, 457s, you can trade in those accounts in many instances anywhere from 12, sometimes as many as 16 times in a year. You're not going to create taxable implications to you by selling within the confines of those 401ks, 403bs, or 457s. It's not until you actually take a distribution that you recognize the taxable implications. However, if it's non-qualified or non-retirement money, you always have to be thinking about the taxable implications, because guess what? If there are taxable implications, you're going to owe them during your next tax return. So let's talk a little bit about the game, and I call it the game of wealth accumulation. So the key thing for most people is to increase their wealth through accumulation. But so many times when we get into these periods of time, what do people have a tendency to do? They have a tendency to make decisions with what? With their heart instead of their head. So one of the things that I tell my clients when we sit down for our annual reviews in the beginning of the year, let's talk about what I call the good, the bad, and the ugly. How about if things turn out just the way that you want them? What's your game plan? How about if things turn out kind of the way you expected? Not great, not bad. What's your game plan? And ultimately, if things turn ugly, very similar to this year, what is your game plan? You want to have a game plan before you come into these periods of time. That's why in many instances, I'll say to clients, tell me what your game plan is, both in good markets and in bad markets, and how do you fundamentally structure your assets? It's important to understand those before you get into these periods of time, because that will give you the necessary roadmap for where you want to get to. We want to talk about reducing taxes and staying ahead of inflation. Staying ahead of inflation today is going to be very, very difficult unless you have something that participates with inflation. With regards to reducing taxes, for those of you that have non-qualified portfolios, meaning non-retirement type portfolios, you should be looking during periods of time like this, in many instances, to do some tax loss harvesting. Why? One of the things that you'll find with many of the actively managed portfolios over long periods of time, the way that they stay so tax efficient is to sell some of those losers during their down years and reposition assets into more favorable investments that they see for the future. So don't be afraid sometimes to take some tax losses along the way if it's part of your game plan. Key element of diversification is always important in periods of time like this, even when sometimes it looks like it's not going to be overly advantageous to you. I'll give you an example. If we look at the global or international type investment arena for the last 10 years, most people would look at it and say, my God, that's a terrible place to be. We just haven't seen the kind of performance that we'd like to see. Well, if you look at some of the best quantitative managers out there in the business, in many instances, this is the time that they'll start to add to their portfolios, especially in areas that have been beaten up significantly. And in fact, there used to be an old strategy called buying the dogs of the Dow, meaning if you bought the 30 worst performing stocks of the Dow every single year, historically, it's had an equivalent performance to the S&P 500 over a long period of time. So very important to pay attention to that. As I said before, build a solid game plan and a solid financial strategy. You don't want to be coming into periods of time like this saying, I'm not sure what I'm going to do. And the reason that I say that is you want to have at least a baseline understanding of what's happening in the marketplace itself. If you don't have that, you need to get with someone who can help you to develop that kind of a game plan that looks at it from about 10,000 feet, which is where I prefer that most clients look at it from, because then they don't get caught up in the everyday herky-jerkiness of the markets. And I'm going to show you some of the relevance of that in a few minutes. The other thing is always make sure that you have enough money to live on with regards to your life options. I call it making sure that you have an adequate cash reserve. When we look at the foundational elements of financial planning and we look at the College of Financial Planning in the key areas, the first one is looking at what do you have in terms of cash reserves and what do you have for rainy days, or what do you have for when markets like this turn and go southbound? Very important to have game plans for this. So what are the key elements with determining that game plan? Well, first of all, let's talk about the time frame. And I like to teach my clients to put their investment vehicles into three typical buckets: short-term, mid-term, and long-term. Why? We know that our longer-term investments historically have a lot more volatility. The short and mid-term vehicles, we typically want less volatility. Why? Because we will need to depend on those in many instances. For example, our mid-term long-term oriented portfolios in many instances will replace our short-term if we've depleted them. So it's very important to structure those short, mid-term, and long-term portfolios to fit your needs. Your needs. Some of you may have very short periods of time. Some of you may have much, much longer periods of time. And then it's going to be critical to put the right investment vehicles into those different buckets. Tax consequences, if they're non-qualified portfolios, meaning non-retirement, you've got them going in and you've got them potentially coming out. What do I mean by going in? You're going to establish your cost basis. Anytime that you continue to reinvest dividends or capital gains and things like that in qualified portfolios, you're going to increase your basis, meaning what you actually paid for those vehicles. That will determine whether or not you've got some additional taxable implications when you come out, or potentially even some taxable losses. Why do we use diversification? Because we're trying to lower the overall risk of the portfolio and hopefully enhance the returns. Liquidity. Liquidity becomes a very key element when you see markets like we're seeing today. Why? Because typically when we see markets that go into these types of downdrafts, and we technically are in a bear market at this point, the S&P 500 has gone down more than 20% from the beginning of the year. What we have to pay attention to is what's happening with the liquidity of the investment vehicles that you own. So for example, if you own investment vehicles that are highly volatile or in very thinly traded markets, your liquidity during periods of time like this can dry up. Very important to pay attention to the volatility components for individual investments in market times like this. Why? Because if that liquidity dries up, there may not be a market for you to sell substantial pieces during these periods of time. I always tell people the best perspective is a long-term perspective. And tonight, we're not really talking about retirement planning, or we'd be talking about the two key elements that people face when they plan for their retirement and they go into that transitional period from working into retirement. The two elements are what we call the high-risk corridor and sequence of returns. They're very critical to retirees or those about to enter retirement. If you have questions about that, we'll talk about that later. And then not becoming sentimental. And I tell people this all the time. I can't tell you how many times I'll ask someone who comes in and I'll say, why do you own this? Oh God, I really love this company. I think that they're the next XYZ. I tell people, please don't fall in love with your investments. They're just investment vehicles. It's not a love affair. I want you to ultimately buy low and sell high, or sell high first and buy low later, for those of you who like to employ those types of strategies. And for many of you, you're far better off if you hold when you're in doubt. Why? Because you're holding the positions that you used your head to develop before you got into these volatile periods of time. And lastly, have a specific investment game plan. Know what each of the investment vehicles in your portfolio is supposed to do. One of the worst things to do is to expect an investment vehicle to do something that it was not designed to do. I'll give you an example. I'm certainly not going to buy a Clydesdale to run in the Kentucky Derby. He's going to finish dead last every single time. But if I want a horse to pull a cart, I will pick that Clydesdale any day over a thoroughbred. So it's very important for you to have a game plan when you come into these periods of time. So let's talk about some of the ingredients that go into this investment cake. Well, there's a basic fact: market declines happen. They happen all the time. There have been numerous bear markets over the past 30 years. We're in one this year. However, the long-term trend has been up over a long period of time, and it will probably continue to be so. Why? Because most of the way that things are incentivized today, especially on the money management side and for corporate America as well, is that there's always this perpetual desire for what? Growth. Growth is the one element that allows us to do what? Outpace inflation over time. And that is critically important for most people because most people have not put away enough dollars towards retirement. So sometimes corrections are good for the market. Corrections tend to be shorter and less severe than bear markets. Corrections occur on a very regular basis. In fact, I'm going to ask questions as we get to the end of our presentation tonight, so you get a little bit of a quiz, but corrections are normal. For those of you out there, you may be saying, boy, we seem to see more of these severe elements more recently than we've ever seen before. Why is that? Well, part of the reason that we're seeing these elements is that we've had the Federal Reserve Bank, which is the fundamental banking elements of our investment system in this country. And they have had to take on a number of very significant challenges over basically the last 10 to 15 years. For those of you who remember back to 2008, the bear market of 2008, what was it caused by? I'll bet you many of you don't remember what the cause was. Well, we basically had seen markets run away. We saw real estate markets run away with themselves, and we made money very, very cheap. And so the money supply, as it continued to expand, offered opportunities for those people who had lots of cash to do what? Put that money to work. They continued to put that money to work because there were some very, very good opportunities. Interest rates were extremely low. So in many instances, especially professional investors, they were borrowing money to invest while interest rates were extremely low. So they didn't have to pay much for those dollars, and the markets were outperforming dramatically. What happened as we came into 2020? Well, we saw the pandemic first appear. We saw a very significant drop in that market in 2020, followed by one of the greatest bull market rallies since then. What happened as a result? We pumped an awful lot of stimulus into this market. And as a result of pumping all that stimulus into the market, it takes a long time to filter through. Well, even though the Federal Reserve has continued to raise interest rates in an effort to keep inflation at bay, there's still many of these programs that are still filtering through, especially in local communities. So there's still a lot of pressure in terms of the demands on the marketplace that are out there today. So it's going to be very difficult to get this particular session of inflation, so to speak, under control. And I think this may last longer than a lot of people expect. So let's look at the S&P 500, because here's a chart, and I love this chart because it shows you the average annual drawdown in many different years for the market itself. And you can see that the market does not go up in a straight line. It is a very volatile component. You're going to continue to see a lot of volatility, especially when you have some people that believe the market is dramatically overvalued and other people who believe that the market is undervalued. That's what makes a very competitive marketplace. But as you can see from this chart, it also portends what? A lot of volatility. And I don't anticipate that we're going to see less volatility moving forward. In fact, I think you'll continue to see more and more, especially as more and more computer programming and algorithmic trading gets introduced into the overall marketplace, not just the US, but the international marketplace as well. So let's examine a couple of key facts, because, you know, when people say, boy, I'm really concerned about where I am in the marketplace, how much of an impact will I have if I try and time this market? Well, as you can see from the fundamentals of this asset allocation, what we've found over long periods of time is that basically greater than 90% of your portfolio performance comes from what? The allocations that you have and time in the market. Second biggest factor is security selection, picking good investments versus bad ones. And then the two other small factors, market timing is a very small factor for most people, and then some other factors as to whether or not you had to get out because of liquidity concerns or other elements. But asset allocation still holds true as the foundational element for most people when we talk about investment planning. They don't have to time the market. They basically allocate their portfolios properly, and in many instances can have their portfolios set up so that they automatically rebalance. So if you have a period of time like we're going through, and you have your portfolio set up for a quarterly rebalance, which many clients do, every single quarter, your portfolio is going to take your top performers, it's going to pare them back a bit, and it's going to add to some of those that have not performed as well. As a result of that, we're hopeful that over a long period of time, you'll buy things at lower prices, and you'll take some of those profits off the table as we move along. So very important to pay attention specifically to having a good asset allocation. And an asset allocation, frankly, folks, doesn't mean just stocks and bonds anymore. I'm going to say a couple of nasty and dirty words for many of you. One of them being commodities. Commodities have wonderful negative correlations to equities and to bonds. There's absolute return strategies. There's call option strategies within both the open-ended mutual fund strategies and closed ends. And I'll talk a little bit more about those as we get further along. But let's look at some of the fundamental facts as well. Okay. Many of you are going to find it difficult to invest when the market is down for two reasons. One, you're going to have a tremendous amount of discomfort in your stomach. By the way, if you think that the pros don't get that same pit in their stomach, don't kid yourself. They do. And in fact, in many instances, when the professionals are unsure of where or how they want to allocate assets, what do they typically do? You'll see them default to doing what? Buying the index itself. So if you look at many of your open-ended mutual funds, and for most people, they have open-ended mutual funds, you're going to find that if you actually do some homework and pay attention to your semi-annual reports and your annual reports, you'll actually get a chance to see many of your portfolio managers holding what we call beta, or the market itself. Why? They're not sure which way it's going to go one way or the other. So as investment professionals, most institutional players will do what? They will default to holding the index. Okay. But it's very important for you to establish your game plan based upon what your objectives are. And I say that over a long-term planning perspective. Why do I say that? Because most professionals who try to do market timing are really bad at it. So if they're really bad at it and they have their fingers on the pulse and have every investment vehicle option available to them, as well as far more research than you'll ever get your hands on, what makes you think that you're going to be able to be competitive with those people who already don't have outstanding track records? It makes it very, very difficult if you think that you're going to beat the pros at their own game. So I tell people, please get back to the foundational elements of your long-term game plan, which is how much do you have to invest? How often are you going to do it? And what kind of investments are you going to invest in? As a result of investing on a regular basis during the accumulation phase, many of you be doing what's called dollar cost averaging. I'm going to quickly run through dollar cost averaging because I'm sure that many of you have heard it ad nauseum. The fundamental premise behind dollar cost averaging is you're going to buy more shares based upon that fixed amount you're investing each month, whether it be your paycheck or an outside investment vehicle. And you're going to buy more shares when those shares are down and less when those shares are up. If your fundamental belief over a long period of time is you've got the right investment vehicle, I suspect that as long as it's not a really bad investment vehicle, you'll do quite well over long periods of time. And for many of you, you have the ability to access not only Morningstar within your qualified plans, but a wealth of other investment research to make those decisions. But dollar cost averaging over long periods of time historically lowers your average price per share. And so it has a nice way of building in a long-term gain for you over time. So very important to do dollar cost averaging. And I tell people accumulation phase for most people is what I call the amateur zone. You get a chance to accumulate lots and lots of assets, and there's no concerns about whether the market's up or down during that accumulation phase. And in fact, you should be hoping for down markets. Why? It gives you an opportunity to buy shares on sale. Historically, markets will perform very well over long periods of time and reward those who have been bold in terms of stepping into the markets during difficult times. As Warren Buffett often likes to say, I sell when other people are very, very greedy. And I try to sell them what they want at very high prices. And I have a tendency to buy when other people are very scared and they're willing to sell me things very, very cheaply. So if you think from that perspective, you'll probably be well on your way to doing things that are very advantageous for you. So let's talk a little bit more now about the marketplace itself, because most people want to measure their performance in both bears and bull markets, and it can be done a number of different ways. It's not just the performance number in and of itself. So for example, if I said to you the S&P 500 today, and I'm just going to pull up a little outside piece and pop it here on this other screen just so we can look. Here's the Dow Jones Industrial Average through today's close, down 14.64. The NASDAQ down 26.76, and the S&P 500 down 18.18%. What we want people to do is to pay attention to those beta type instruments. Why? Because for most people, those are going to be the foundational elements that they're going to use in building their portfolio. What are the most common ones they're going to use? S&P 500 and the NASDAQ are by far the two most common elements that you'll see people using on the equity side of the equation. On the fixed income, most people are familiar with the Ag Index. Used to be the old, now it's the Barclays Ag Index, but it used to be the old Lehman Brothers Aggregate Index, and that's a measurement of the 4 investment grade categories of bond funds: AAA, AA, single A, and triple B. Another way that people will measure their investment vehicles, not just against beta or the benchmark itself, they'll look at the standard deviation of their portfolio and then measure that against that particular index or beta element that they want to compare it to. So for example, let's say you have a large company growth fund and it's benchmarked against the S&P 500. You want to see what the standard deviation of your fund is versus the benchmark itself, the S&P 500, to determine, do I have an investment vehicle that's greater or less risky than the index itself? And you want to pick something that fits your profile. Some people are going to say, I want more risk than the market itself. Other people are going to say, I want less risk than the investment, than the market itself. So you want to determine the types of vehicles that you invest in part based upon how much volatility does that underlying investment have when you compare it to the market itself. There's a couple of fundamental strategies that many people will use: passive versus active. Over the last 10 to 20 years, there's been an extreme movement to the passive side of the equation, essentially just buying the indexes. Why? Because historically, 85% of all money managers don't beat their indexes. So if they don't beat their indexes, is it worth paying for an active portfolio manager to select investment vehicles based upon their proprietary measurements of risk and return? Sometimes it is, especially if they've got really good long-term track records. But if you're not sure who to choose, in most instances, you're probably better off if you're buying the market itself. And then active management does what? Active management digests the investment market in many different ways, but they'll scrutinize through security analysis, attempting to find stocks that will typically outperform over longer periods of time. They may favor particular managers of individual companies. They may choose to look at it more from a technical basis versus fundamental analysis. Two fundamental differences being there. Fundamental analysis looks at the underlying metrics that a company has. So for example, price to earnings ratio, price to sales, all those different measurements in many instances are some of the fundamental analysis tools that will be used by fundamentalists to determine, are the investment vehicles undervalued, fairly valued, or overvalued? Technical takes the fundamental components and typically throws them out. So I'm going to bring up that little chart that I had before. This is TC 2000. And one of the things, let me just switch the data. I'm going to switch to weekly. Because when we look at this, one of the key things that we want people to always be paying attention to is what's happening in the marketplace, both from a volume standpoint. And you can see where I have my mouse kind of scrolling now. This is the volume activity in the marketplace. This is the Dow Jones weekly. This is the daily. And as you can see, there's been a fair degree of volatility. This was the high. If we go back, let me go all the way back to the beginning of the year. Here was your start in January. So we started, basically, this was the high. We then had what happened? Well, we had a downdraft. We made another high, but this was a lower high. So from a technical standpoint, this would be a technical key that many technicians would look at and say, well, you've made another high, but it's a lower high than the prior one. Then we have a subsequent high. Again, this high was lower than the prior high. Another lower high. And longer term, another lower high from the prior peak. These are all negative technical sentiments about the marketplace. Why? Because it's essentially saying to us, there's not enough willing buyers to step in when we get back to some positive times and really push the market over key elements that may be used as either resistance or support. When we talk about resistance and support, we're talking about technical levels. So here you can see the red line is what's called the moving average, the 40-day moving average, and the blue line is a 200-day moving average. Why did I choose these two? The 40-day is basically a short-term moving average. I want to see, are the markets showing us a propensity to move the short-term direction from down to up or from up to down? The longer-term one tells me whether or not I'm going to get support at particular levels or if I'm going to hit resistance. So let's look at the blue line, for example. When we started to come into this period of time, we had come from a bottom. The 200-day moving average was now what we call resistance. In other words, we were having difficulty getting above it. And as you can see, we challenged it here again. We could not break through, and what happened? We then subsequently went down. When we went back and tried to pierce that 200-day moving average again in August, what happened? We got up to it, bounced against it again, and headed back down again. These typically are weakening signs for the market. It tells us that the market is not in a position that it's very, very strong moving forward. It says people are essentially saying, I'm not willing to put additional dollars into the marketplace, and they're typically selling off the portfolios. So let's hop out of that and get back to our presentation. So let's talk a little bit more about these two elements, technical analysis and fundamental. Technical focuses on supply and demand. And as you saw from that chart, you could see the supply of willing buyers versus willing sellers. When we had more willing sellers, you saw a red line. When we had more willing buyers, you saw a green line. So as you saw by the end of today, we actually had a little green line to the upside on a daily basis. However, the volume was very low. So that volume tells me there's not a lot of willing buyers willing to step into the marketplace. It relies on timing. So historically, most people are A, not very good at it. Two, they don't want to sit there and have to pay attention to this on an ongoing basis. But I have to tell you, there's plenty of professional managers that do technical analysis. So if it's something that you find interesting and you think it could be advantageous, it can work quite nicely as an adjunct to a fundamentally structured portfolio. The other thing that it does is it looks at the market trends, as I just talked about, 200-day moving average, 40-day moving averages. I won't get into a lot of the technicals about other elements. If you understand, it basically just looks at trends in the market, both from a supply and demand basis, and also where are the rotational components happening. So when are we seeing things, for example, move from large company stocks to mid-sized company stocks to small company stocks? And are there fundamentals in the economics that are happening that are causing this? So in many instances, what you'll see is those professionals put things together. So it isn't just operating technical analysis all the time or fundamental. In many instances, most professional money managers are incorporating both of those things. And as I said before, since you're looking at those types of elements, in many instances, they'll also start looking at the pricing and the sales volume or trading activity. They are more concerned about what the market is doing rather than the pure economic elements. Fundamental analysis goes exactly the opposite. It looks at the pure economical data of a company. And there are three fundamental things that they'll look at. One is productivity, another one's profitability, and ultimately earning potential. So that's why you'll see sometimes major mutual funds during periods of time like this, if they really like companies that are in growth-oriented stages, Sometimes they'll look at these things and say, wow, this is a great time for us to add fundamentally to sound companies that they really like. But because of the overall environment, they're being taken down just like everyone else in the marketplace. So both of these components in many instances can be added to your fundamental investment thesis, or you're going to have a combination of the two. So what do you want to do when the market is in a decline? Well, I tell people you want to evaluate specifically each investment and how it's performed versus the marketplace. And then the second thing you want to do is compare its performance against its peers. So how is if you have individual investments or you have mutual funds, and sometimes even ETFs, you want to compare them against their market, first and foremost, and then secondarily against their peers. How do they stand up? Are they doing a good job? But you can't just look at it based purely on performance. You have to look at it from a number of different standpoints. We talked a little bit about standard deviation. So you need to understand, is this, for example, is your particular investment portfolio, is it oriented more towards fundamentals, or is it oriented more towards technical, or does it have a combination of the two? You want to understand that before you go in and evaluate it. And then the other thing is make sure you're comparing it to like type items. Don't compare an apple to a peach. Don't compare a large cap growth stock or fund to a small cap. They're in totally different universes. They may be impacted very similarly by the economics of the day, but they're in totally different universes. Do selectively sell some of your losers. I tell people on a regular basis, it's important to harvest losses during periods of time like this, especially in non-qualified portfolios. Why? Because it gives you the opportunity to provide liquidity for highly appreciated positions on the other side. If you sold some losers this year, and let's say you sold some losers last year and you're still holding some sizable winners, and the market goes further south and you'd like to play a little bit of defense, now you may be able to liquidate some of those really significant long-term capital gains positions that you have by sheltering them from the losses that you recognize by harvesting them in the past. I always tell people, rebalance your portfolio. You should be sitting down, if you're using an advisor, at least once a year. Make sure that your portfolio fits in relationship to where you started out. Because historically, if you don't pay attention to your portfolio and you leave it alone for 4 or 5 years, you would be stunned at how significantly different the weightings will become. Also, it's very important to understand, are those weightings and allocations that you have the ones that you want for that particular sector? Let me give you an example. Many of you today will have what's called target date funds in your retirement plans. They're wonderful. But if you had a target date fund, and they typically operate on 5-year increments, and let's say you were going to retire in 2025, that's the closest retirement date that you would find for a target date fund today. You're only basically 3 years away. Well, if we go back to 2008, the closest was 2010. If we went back and looked at how that portfolio for someone who is about to retire just 2 years out would be allocated, 15, 20 years ago, it was a 55-45 allocation, 55% stocks, 45% bonds. If you looked at that same element today, and it was benchmarked against the S&P 500, it would be approximate weighting of 67-33. Why? Why would those allocations be so dramatically different? Because the yields on bond funds are dramatically lower than they've ever been historically. And there's an anticipation that you'll see a lot more volatility with a lot more potential losses during an interest rate move to the upside. So where do people historically have a tendency to move? They're going to allocate more towards equities. And in many instances, they're going to look at equities that have dividend components that are at least equal to, and in some instances, providing greater returns than what they could have gotten out of their fixed income portfolios. And lastly, I tell people, always monitor economic news for any fundamental changes in the direction of the economy. because that's going to give you an indication of whether or not you're potentially going to be in for a bit of a bumpy ride and you need to kind of strap in with your seatbelts, or it looks like things are operating as we expect them to. Markets love that. They have a tendency to be far less volatile during those periods of times. During periods of uncertainty, markets have a tendency to want to do what? They like to be extremely volatile, number one, and number two, they have a tendency to become very highly correlated. It doesn't matter which asset class that you have. In many instances, you'll see a higher degree of correlation during down markets. So if I go back to 2008, basically what you would notice is that many of the investment grade bond portfolios did not perform very, very well. They went down just like the equity markets did. And if you look at it this year, equities are down, so are fixed income portfolios. Why? Because as interest rates rise, what happens to principal? Principal drops, and vice versa. If interest rates were dropping, principal values would rise in bond portfolios. The key element for you to pay attention to today to help to decrease the volatility in those portfolios, to look at the duration of your portfolio. Duration tells you how interest rate sensitive are the investment vehicles that you have compared to their indexes. So virtually every index out there that's benchmarked against investment grade bonds is going to be benchmarked against what? It's going to be benchmarked against the Barclays Aggregate Index, which is those 4 key areas. So very important to pay attention to the economic news and how it potentially will impact your portfolio over time. Some more do's and don'ts. I tell people, don't panic. The market's going to offer you lots and lots of times to see this happen again. History, when it comes to markets, has a tendency, it may not repeat itself, but it has an awful lot of rhymes. And in many instances, you can see why those things are going to rhyme in the future. So please pay attention. Don't sell all your investments at the time that the markets decline. I can't tell you how many times I've had people come in and say, I just couldn't take it anymore. In which case, my first question is, when you sat down and you looked at allocating your portfolio, did you think about what the worst case scenario would be and whether or not you could handle that? That was the time to make the decision. Not when you got into the throes of the volatility and then said, I can't take it anymore and you're down 40%. I can guarantee you that you're going to lose a lot of money by making those decisions. If you're not sure what to do in many instances and you're a long-term investor, leave it alone, especially if you've made good decisions with your head and not your heart. Don't jump into the stock market with all of your available cash, hoping that the markets hit a bottom. You'll have a tendency to do what? Try and catch a falling knife. It's a lovely metaphor that the market uses time and time again. But I tell people, don't try to time the market. If something's gotten down into a pricing range that you feel is pretty competitive and you've done some analytical work on it, don't be afraid to step in and buy spend some dollars and buy that position. You don't have to buy the whole position now, especially if you're uncertain. A lot of money is made in the middle 80% of the market. For people who are out there trying to time the bottom 10 or the top 10, that's tough to do. If you can take some off the top when you've hit the top, take some off the top, build some cash for a rainy day, have some cash sitting there as dry powder available to buy some things. One of the things that I said to my clients early this year was, if we looked at any historical metrics of valuation for these markets, this market was expensive. We had historically low interest rates. You had many things that were stacked up against the market longer term. So what we did was we took this into account. For those clients who needed additional cash, we liquidated some of those positions at the top of the market. I didn't know it was going to be the top. It wound up proving to be a great time to get out. I'm not a savant. I don't claim to be. It fundamentally made sense for my clients to pay attention and plan ahead, so we did so. For my clients that were getting very antsy, that have had a number of very good years of investments, I said, look, maybe it's time to take some of these things off of the table. And especially if you've got non-qualified account investments, meaning non-retirement account investments that you've had for long periods of time, especially if they're open-ended mutual funds, you may be in for some rude awakenings this year when those portfolio managers sell out some of those positions that have large long-term capital gains, and you're buying into the fund and have no idea that you're about to buy a big tax bill. So please check those mutual funds if you're starting to buy into them now, so that you're not buying into very, very large taxable implications the end of the year when they start to release long-term and short-term capital gains. And lastly, don't listen to the Wall Street pundits about the short-term direction of the stock market. I can't tell you how many prominent investment money managers over the years have been caught with their pants down, for lack of a better expression, after prognostications that they've made that have been completely wrong. Because if they were so right, why don't they bet every dime and dollar on that direction that they believe that the market's going to head? None of them ever do. Why? Because they know the markets are incredibly fickle. You still have to maintain your fundamental allocations. The way that they'll make those decisions in most instances is they'll overweight or underweight sectors. Overweight the sectors that they think will outperform, underweight the sectors that they believe will not perform that well. Why? It's important for them to stay in close ties with their benchmark in many instances. That's what they're being judged against. So it's very important to pay attention. And I also say this to many people: find out how much of your money manager, how much of his money is invested in the portfolio that he's managing. I have a tendency to want to buy into portfolios that money managers have a lot of their own money in. Why? Because I want them to feel the pain too. If they're investing money for my clients, I want them to have their money right in with my clients and feel the same elements of pain. Because in many instances, if you look at the prospectus for those investment vehicles that you buy, especially mutual funds or ETFs, they will tell you in the prospectus, we must be 95% fully invested at all times. They're not given the opportunity to move cash to the sidelines. They're managing the money for the portfolio, not for you individually. If you can't take that risk, you have to make that determination to make a move to the sidelines. So we're going to get into a simple quiz. If you have a piece of paper, I'm going to have you record your answers. So this is 95 years worth of data. This is from 1926 to 2021. How many times has the S&P 500 had a loss of 12% or more? Please write that number down, remembering we have 95 total trials. How many times has the S&P 500 had a small loss of 0 to 11.9? How many times has the S&P 500 had a small gain of between 0 and 11.9? And how many times has the S&P 500 had a gain of greater than 12%? So I see a question in the Q&A. Let me just see what we popped up. Okay, so I've asked you guys that question. How many times on average do you think that the S&P 500 has lost more than 12%? Do you think it's more or less than the number of times that it's had a gain of greater than 12%? Answer that question in your head. And same for the other two. A loss of less than 11.9, 0 to 11.9, or a gain of 0 to 11.9. Okay, so now you've had a chance to see that. Sometimes if we have questions going along, I will ask people. Let's see, I see a second one. What the heck is S&P? S&P is the Standard & Poor's 500 index. That's what you're typically going to hear when somebody says, how did the S&P do? They mean the Standard & Poor's 500 index. That is the 500 largest companies in the United States. We use that as the benchmark or barometer for how our economy is doing. In the old days, they used to say, how's the Dow doing? The problem is the Dow Jones Industrial Average, is not an accurate reflection of America today. The S&P 500 is a much, much better choice. So I'm going to show you the results now. So 12% or greater, 7 years out of the last 95, or 7.4%. From 0 to minus 11.9, you had 18 years or 19%. Between the two, they combined for 26.4%, or about a quarter of the time you're going to have losing years. But you've had 20 years or 21% of the time that you've done between 0 and 11.9, and folks, 50 years where you've done better than 12% a year, or better than half of the time. So when people say to me, I'm not sure I want to stick it out in the S&P 500 over a long period of time, I go, show me a better place to be. Understand the variables that you're dealing with. I'm going to pop you into a couple of questions. Oh, just one second. No. So here's some key questions that I like to ask people. The first one is, how many times on average does the market see a 5% correction? How many times does the market see a 10% correction? How many times does it see a 15, 20, and 30% correction? Are we technically in a bear market now? Have you developed a game plan for this type of market? And if so, are you currently a buyer, or are you a seller, or you're not sure? What's the primary objective for your portfolio? I don't care what the money manager's objective is. What's yours? Does this market offer you opportunities, or does it offer you pain? And what negative elements should you be aware of in your mutual funds during a market downturn? Well, let's look at what some of those answers are. So 5% correction, you're going to see that roughly every 1.1 years. 10% every 1.6 years. 15% every 2.5 years. 20% every 4 years, and a 30% correction every 9 years. So based upon the last market correction or bear market, 2008, we're 14 years later. So we were well within the time parameters to expect a 30% downturn. Will we get that? Not quite sure. Technically, the market entered bear market territory on June 13th this year after falling more than 20% from the high in early January. As I say, develop a game plan each year for your portfolio. Base it on what I call the good, the bad, and the ugly. I tell most of my clients when we do planning, plan for the worst case scenario that you can make it through. Anything above and beyond that, you're probably going to be reasonably happy. And make sure that you don't set yourself up for the ugly. Next, you have to understand the objectives for your portfolio to answer this question. So many times, people don't understand what their portfolios are designed to do. If you're not sure, get with someone who can help you so you can understand how the different pieces work in your portfolio. Are they complementary? Do they work together? Are they negatively correlated? For many of you, you may say, what does negative correlation mean? Well, the best way that I can think of to explain it is, if you own a power shop and you sell snow blowers, you can do really well in the wintertime. But what do you do in the summer? Well, for most of you out there, you probably know most of those places also sell what? They sell lawnmowers and all the weed whacking equipment for the summer. Two totally negatively correlated options. You're only going to do well with the snow blowers in the winter, and the same thing with the lawnmowers in the summertime. But each one of them can provide that business with a very solid income over a long period of time. And lastly, folks, and I said this before, do not forget that down years usually have significant capital gains that get recognized by open-ended mutual funds. If you're in those, or if you're about to buy them, are you in for a huge tax bill? Please pay attention to that before you buy them, because if you don't, you're going to get egg all over your face. And not only are you going to get egg all over your face, but you're also going to have a big tax bill. Here's a couple of additional questions. If I want to lower my overall risk, what types of strategies would naturally be oriented that way? I can't live on the income from my investment grade bond portfolio, which I've heard from many people over the last number of years. What other options might fit for income-oriented investors? And is this a good time to potentially be adding them? All of my assets are in stocks and bonds. How do I decrease the overall volatility in my portfolio in a rising inflationary environment? I have individual stocks in my non-qualified portfolio. What can I do to potentially enhance my income? I can't get enough income from my portfolio. What else other than open-ended mutual funds should I consider outside of individual equities or bonds? Are there any investments that can keep pace with inflation? For those of you who are 59 and a half and in a 401k or a retirement plan, and you say, my investment options in my plan are lousy, is there anything else I could possibly do with my portfolio? I would tell you to explore and see if you have what's called in-service capabilities, meaning you're still in the service of your employer, but because you've reached that age, if your plan documents allow it, you may be able to roll a portion of those assets out to a self-directed IRA and choose investment vehicles that better fit what your needs are moving forward, especially if you're getting close to retirement. And is there any investment that protects against the downturns with guarantees? So let me answer those. The first question was, if I want to lower my overall risk, what kind of strategies? Well, you can certainly consider what we call absolute return strategies. In the old days, many of the hedge funds that were originally out there, they were designed to do what? They were designed to hedge the risk out of your stock and your bond portfolios. It's only the last 20 years or so that they have done what? They've actually, in many instances, increased the leverage. So for those of you looking to decrease, look for investment vehicles that are negatively correlated to the investments that you already own. Second question, if I can't live on the income from my investment grade bond portfolio, what other options might fit for income-oriented investors? Well, high-quality dividend-paying strategies might be a perfect option for you. They're available from open-ended mutual funds as well as closed-end mutual funds. But I signal one key element for you to be aware of. Please look at the leverage of those portfolios. Know what you own. 3, all my assets are in stocks and bonds. How do I decrease the overall volatility in the portfolio in a rising inflationary environment? Well, one of the things that we typically want to buy is what? Negatively correlated assets. What are negatively correlated assets to stocks and bonds historically? Well, we would typically think of real estate as being negatively correlated. It typically does well during very, very high inflationary environments. And also commodities. Why? Because if inflation rises, in many instances, commodities have very limited amounts of supply. So as a result of that, the pricing typically goes up and up significantly. So if you look at 2008 and you look at this year, you're going to find that most of your commodity-oriented portfolios are performing quite nicely this year. Question 4, I have individual stocks in my non-qualified portfolio. What can I do to potentially enhance my income? You could potentially institute what's called covered call writing strategies. For some of you out there, you're probably going, what the heck is he talking about now? This is an option strategy. Options are a more sophisticated investment vehicle that allow you to purchase a contractual right to either buy or to sell a stock to the person who wrote the option. So there's 2 types. One is called a call option. One is called a put option. A call option says I can call the stock from you within a given period of time as determined by the length of the option that I purchase. And I would call it from you if the strike price on my option was less than what the current market price is. So for example, if I'm someone that owns, let's say, UPS, and I said, I've got a fair amount of shares of UPS, but I don't want to sell it, but I'd like to bring in some additional income. So I'd like to add option writing capabilities to my portfolio. You'd have to do that through your brokerage firm. Then you have the ability to write an option. An option basically covers 100 shares of stock. So I'll keep it simple. You sell one contract. That contract covers 100 shares of stock. If that option, and let's say the option is a 6-month option, you're going to take a premium in for it. In other words, somebody's going to pay you for the option to buy it from you at a particular price. So let's say the stock today sells at $175 a share, and they buy the option from you at, say, a strike price of $180. Well, they're not going to exercise that option unless the price of that stock gets above the strike price. It's at 175 now. You purchased a right to buy it at 180. If it goes to 185, the person who bought that call option is going to call that stock from you at the $180 strike price that they bought, that you executed the contract on. So you're going to be forced to sell them at 100, sell it to them at 180, and they're going to turn around and be able to sell it in the market at 185. This strategy in many instances works very well for people who have capital gains in their portfolios, aren't afraid to recognize some of those capital gains, but also want to bring in some additional income right now. Let's say that that particular option I just talked about never got to be $180 a share. What happens for you as the writer? You get to keep that premium. That's what someone paid you for the right to be able to buy it from you at $180 a share at a later date. If it never gets that price, you get to pocket that premium. Why is that such a successful strategy? Because over 90% of the call options that are written go unexercised. So it's a wonderful way that sophisticated individuals in many instances can enhance the overall income in the portfolio. 5, I can't get enough income from my portfolio. What else other than open-ended mutual funds should I consider outside of individual equities or bonds? For many of you, you can take a look at what's called closed-end portfolios. This may be a new term for you. Here's the best way to think of it. Open-ended mutual funds, something that you bought from a Fidelity or T. Rowe Price or a Vanguard, are what we call open-ended mutual funds. The fund company gives you liquidity every single day that the market's open. They will price your shares at 5 p.m. and you'll always have someone that you'll be able to sell your shares back to. That's how an open-ended mutual fund works. Closed-end funds are basically a finite set of assets that were developed in the beginning. Portfolio manager can buy and sell things internally, but you don't go and redeem your shares by going to the vendor. You actually sell your shares in the open market, similar to the way that stocks trade. So you're going to buy and sell the individual shares in the open marketplace. So there has to be willing buyers and sellers, but it's not the vendor who made that portfolio that you're going to deal with. You're going to deal with the open market, and you're going to sell it based upon supply and demand. Many of these closed-end portfolios, because portfolio managers don't have to answer the liquidity issues of a public that may say, I don't like what's going on, we need to liquidate. They don't have to keep excessive amounts of cash available. Why? They're not redeeming for you. They're continuing to hold those portfolios. You accept that volatility of the underlying portfolio, and sometimes you can buy some very, very good portfolios, but historically, they may carry more volatility than what you are or are not comfortable with, but it's worth looking at, especially if you need a sizable amount more of income. Next, are there any investments that can keep pace with inflation? Well, I tell people consider I-bonds. I-bonds are backed by the federal government. It's basically a savings bond, but it's inflation oriented. But you can't have a need for the money right away. Why? Because if you hold the portfolio for 5 full years, if you hold an I-bond for 5 full years, you get all the interest that gets credited to that account with no reduction at all. There's no surrender charges. If you hold the portfolio for at least a year, but not the full 5, you're going to have to give a quarter's worth of interest back. If you don't hold it for at least that long, you'll lose the interest that you acquired for that period of time. So I bonds are very popular right now, although there are some limitations as to how much you can buy. $10,000 per Social Security registration. So husband and wife could buy $10,000 each. That's it. That's the maximum that you can buy. You can buy $10,000 each year. That's all you can buy. Current interest rates on I bonds are in the 9% range today. So as I tell people, as a long-term bucket for high quality investment vehicles, although it's taxable, I bonds are very attractive today because of the interest rates that you can get, and there's no downside, no volatility as to principal, very similar like bond portfolios. And then, as I said before, if you don't like your investment plan and you're over 59 and a half, check and see if in-service withdrawals are available to you. And then lastly, is there any other investment that protects against downturns with guarantees? Well, there are. There's a number of different annuities that are out there, primarily on the index side, which will allow you to choose whatever index you want, whether it's S&P 500, whether it's the NASDAQ, whether it's the Russell 1000. Now they've expanded to many, many different options. But you can choose to participate in that. If the portfolio goes and has a negative year, you just don't earn anything. If it has a positive year, as a result of your not taking any of the bad, they will cap you on the upside. But for people who are very risk averse, in many instances, these are ways to get competitive rates of return over significant periods of time, maintaining tax deferred statuses, and also be able to get exposure to those particular indexes that they like, even though it's not full exposure. And as I said before, please don't forget that during down years, you're usually going to have significant capital gains bills that get recognized by open-ended mutual funds. You will typically have them release that information around the middle of November. So we're closing in on that. So I would tell each and every single one of you, if you're about to purchase anything in your non-qualified portfolios before the end of the year and it's a mutual fund, please check and see how much is going to be released in long-term cap gains, or you may wind up buying yourself at just a massive, massive tax bill. Well, I want to thank all of you for joining me tonight. As I say, normally I'd ask you for evaluation forms, but let's open it up for any questions that people have.
And just as a reminder, you can put your questions in either the chat box or the Q&A. I'll be looking at both. We did have a question earlier asking, will the recording be shared? Yes, the recording will be shared in the library's YouTube channel. If you want to wait a couple of days, usually is what it takes for them to get it up on the YouTube channel. I do have a couple questions that were direct messaged to me as well.
Sure.
The first question, what signs should we be looking for that shows that the market is recovering?
The best way to see whether or not a market is recovering is to look at what we call the breadth of the market. So let me just pull up that other piece real quickly. Okay. So one of the key elements that I pay attention to, and you can see up here, this is the Dow Jones Industrial Average that I've got here. Let's change it to the S&P because that's the more commonly known element that people are going to pay attention to. I can look at it in minute increments, 5 minute, 15, an hour, daily, weekly, monthly, quarterly, or yearly. I try to look at the weekly charts. Why do I look at weekly charts? Because weekly charts will give me a better barometer of where we stand. As you can see here, one of the key things that I start to pay attention to see if we're moving from bad times to good times is I want to move out of the heavy red volume areas. As you can see, this is going back to the pandemic in 2020. What did you see here? Here's the volume, okay, that we looked at. This is weekly. You could see that volume, based upon the red, became extremely excessive in this period of time. Look at the downdrafts. They were huge. What happened as we started to see things finally start to move? we start to see the green volume starts to really outpace the red, not just on a 1-day basis or a 1-week basis, but over multiple weeks. And as you can see, here we had resistance to the 200-day moving average to the downside. Once it broke through, you saw a lot of sellers. It didn't look like we could get any further down, so all of a sudden the buyers started to show up the following week. Then what happened? You start to see the green outpace the red, and so you started to see the market rebound. As we got to this top, what did you see here? Now you start to see more willing sellers coming into the marketplace versus willing buyers. So I would tell you to look at two things. You want to start to see that the up volume is beginning to increase. And also, if you've got mutual funds or ETFs, start paying attention to what's being added and what's being eliminated in those particular portfolios. That will give you an idea of whether or not they're beginning to rotate from one particular sector to another. So for example, the beginning of the year, we still continue to see an awful lot of activity in technology and biotech. As we've gotten to the latter stages of this year, and there's been a great deal of concern as a result of the Fed raising interest rates, what are people anticipating? Well, now these high multiple stocks, of which technology fits in, have come under a great deal of pressure because people are worrying about the fact that these companies may not be able to continue to have these heavy growth-oriented spurts moving into the future because things are becoming much, much tighter. But in terms of seeing a change, pay attention to the volume and see where the money is going. That will tell you when we're starting to move out of those periods of time. Next question.
Next question. Could we email the evaluation form to you?
You could, sure you can. I didn't post it up there, but you definitely could. If you've got an evaluation comment, feel free to email me either way. It's mark.lang@lpl.com. I love when people send me emails. Sometimes they're questions about their personal situation, or they learned something new, or I covered something and they said, my God, you fed me with a fire hose. It's just entirely too much stuff, and I need to ask a couple of questions about it. So whatever the case may be, feel free to reach out to me at my email, which is mark.lang, Lange, @lpl.com. I'd be more than happy to answer your questions.
Okay, and the final, oh no, wait, there's another question that came in. I can't see
Okay.
the final question. Would you forward the form in the chat?
Would I forward the form in the chat? In fact, I should send that to you guys. I'm not quite sure how to do that, but I will do that so that we can get it to the library and then you guys can send it back to us.
You can forward it to me, and then I'll forward it to everyone who attended today.
Perfect.
And the final question I now have, what are the best industries to be investing in right now?
Well, you know, it's interesting. I tell people, you don't drive your car by looking in the rearview mirror. So historically, the best investment industries are the ones that look the furthest into the future. So when I have many of my clients come in and we start to develop portfolios, especially for their children, their grandchildren, I ask them, where do you think the future will be? Not where it is now, but where do you think it will be in the future? I have some areas that I like a lot. I think that software will continue to perform very, very well for an extended period of time because we're continuing to see new programs come out for these lovely digitized elements that we've stuck into our lives every single day, whether it comes out on your telephone or it comes out for your desktop. Software continues to evolve. So it's an area that I continue to like a lot. Another area I like a lot is agriculture. There's only a certain amount of land that we have available to produce food for people on this planet, and it continues to get contaminated at a rapid rate. I think that that will be a key area to make good money in the future. Same thing with water. I think clean water will become one of the most valuable commodities in another 15 to 20 years. I think that robotics will be dynamic over the next 20 to 30 years for a couple of reasons. First, go to YouTube and take a look at what Elon Musk has to say about robotics and the fact that we may see as much as 30% of our current workforce eliminated over the next 10 to 15 years by robots. He's already got the personal robot out. He expects it out for individuals within 5 years. And I suspect that people will become quite accustomed to the Jetsons. And now I'm kind of aging myself. But, I think you're going to see robots in the home in a not too distant future. And I think that will be a tremendous assistance for those who have elders. Why? They'll be monitoring them 24 hours a day. You don't have to worry about them falling asleep, and they will know who to contact, when to contact them, and so forth. So I think robotics and automation will continue to expand. Artificial intelligence, I think, will continue to expand. But those are the areas, technology in those areas are going to be the growth areas of the future. The things that we put into our mouth, food from an agricultural standpoint, water, I love all of those areas. And then ultimately, no one seems to want to talk about it today because it seems to be taboo. But I think that nuclear energy over the next 25 years will become a dynamic investment vehicle. Why? It is the cleanest way for this world to produce energy. In fact, I tell people the Ronald Reagan aircraft carrier, which houses approximately 6,000 of our troops, operates 24 hours a day, 365 days a year for 30 years on plutonium that basically would fill a crash helmet. That's right, a crash helmet you would put on your head to ride on a motorcycle is the amount of material that's used in that nuclear reactor to run that ship, which is 3 full football fields long, 365 days a year, 24 hours a day at full power for 30 years. Think about how efficient that is compared to many of the other green things that we're looking at today, whether it be wind, whether it be solar, whether it be algae, whether it be so many of the other elements out there. I think that many of those particular areas will also be growth areas, but I think you may run into some situations where, did you choose Betamax or did you choose VHS? And then we come to find out later on that both of them are eliminated. So it's very important to pay attention to the ever-changing elements of technology and society moving forward, because those who don't pay attention will be left behind. Everybody thought that VHS and Betamax was going to be the way to go. Then all of a sudden Blu-ray came out and everybody talked about how wonderful that was. Now we have streaming. So you have to be very adroit at paying attention to the changes in the landscape, because there's going to be good ones and there's going to be bad ones, but you have to stay on top of them, especially if you're going to stay on the cutting edge areas.
Excellent. Thank you. I have no other questions in the chat, so I want to end by saying a big thank you first to the people who attended this evening. Thank you so much for coming out and spending your evening with us. And I also want to say a big thank you to you, Mark, for coming out and volunteering your time to give us this very educational webinar this evening. Big thank you to you.
My pleasure, and thank you for all of you that joined me this evening.
Have a good evening, everyone. Thank you again.
Good night.
Good night.